Hi everyone, welcome to another episode of the Mizuho Week Ahead. I am Jin-Yi, market economist at Mizuho Bank. The theme for the upcoming week is In the Woods. Risk sentiments were soft last week, with global equity indexes broadly lower. While growth risk remains in the spotlight, cautious FedSpeak and imminent US elections, leading yields higher may have triggered broad-based liquidation from risk repricing. IMF downgraded global growth estimates for 2025, although US and Japan were notable outliers, which saw upwards growth revisions for 2025. While China's growth forecast for 2025 was left unchanged at 4.5%, and the 2024 downgrade revision to 4.8% from 5.0% could be considered a belated downgrade, qualitative evidence suggests shaky confidence on China's growth. Notably, China's stimulus was merely flagged as an upside risk, and IMF officials commented that China's recent barrage of fiscal measures falls short of what's needed to address deflationary risk. Meanwhile, the parade of briefings by Chinese officials in the past few weeks took a pause, although Vice Finance Minister Liao Min commented last Friday that the stimulus will be of quite large scale. Chinese banks also cut their loan prime rates by 25 basis points last week, following the quarter-point cut to bank deposit rates a week prior. South Korea GDP barely managed to eke out gains. Q3 GDP only managed a 0.1% quarter-on-quarter expansion against expectations of a 0.4% growth, which could allude to risks from a softening export rally. In the background, Brent Crude gyrated on geopolitical shocks and supply glut contemplations, adding to the deluge of considerations that markets have to consider. Against this backdrop, it is perhaps not surprising that risk sentiments took a backseat, supporting the dollar, especially also as Trump trade bets may have somewhat returned. The DXY moved higher to around mid-104 levels from below mid-103 at the start of the week. This week, Bank of Japan is set to maintain status quo. As Governor Ueda had stressed, Bank of Japan has time on its side, and patience may be the path of least damage, especially as neutral rate levels have yet to be ascertained and against the backdrop of deflation risk re-emerging, fragile consumer and Japanese yen considerations. But downside risk to the yen, as the LDP failing to win majority seats over the weekend, could cast an overhang on fiscal policy trajectory. US and Eurozone GDP releases could see two-way volatility as markets consider how the balance of risk shape on growth soft spots and resiliency. US NFP print will again take the spotlight as everyone contemplates if the US labor market is out of the woods or lost in the forest. Meanwhile, Taiwan's GDP is expected to moderate from Q2 on a year-ago basis due to base effects, but will represent a faster quarter-on-quarter expansion. Our upbeat view takes into account resilient external demand, while firm domestic growth engine in finance and insurance sectors should offset some soft spots of weakness in retail sales and services. Down under, sticky inflation print will prolong RBA's hold, though Aussie dollars rallies remains at risk of being faded, as has been the case especially if the retail sales exhibit weakness. All in, markets are likely to be still navigating in the woods this week with heightened two-way volatility expected. With that, we have come to the end of this episode. For more information on the key events for the upcoming week, please refer to our Week Ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you and bye-bye.